There is a ghost that haunts Wall Street. It's a silent, invisible force that dictates the fate of trillions of dollars, fires brilliant executives, and crushes promising companies. It isn't a person. It isn't an algorithm. It is a unit of time. 90 days. The fiscal quarter. This 3-month window is a tyrannical obsession, a collective psychosis that has gripped the entire financial world. Every 90 days, the giants of industry are forced to their knees to confess their performance, and every 90 days, the market sits in judgment, ready to deliver a swift and brutal verdict. A company can have a revolutionary product, a visionary leader, and a plan to dominate the next 20 years. But if it misses its quarterly earnings per share estimate by a single penny, its stock can be vaporized overnight. This is the world we live in. A world of short-term panic, of myopic reactions, of trying to predict the unpredictable tides of a single season. And in this world, there is one man who has built an empire of staggering proportions by committing the ultimate heresy. He ignores it all. Warren Buffett's true secret, the foundational principle that underpins his entire philosophy and explains his almost incomprehensible success, is not a complex formula or a secret source of information. It is the simple yet profound act of operating on a different clock. While the world's most brilliant financial minds are obsessing over the next 90 days, Buffett is thinking about the next 90 months. While they are analyzing quarterly reports, he is analyzing decades. This fundamental shift in time horizon is not merely a preference, it is a weapon. It is the lens through which he transforms the market's greatest weakness, its pathological short-sightedness, into his greatest strength. It allows him to see value where others see risk, to find opportunity where others feel panic, and to hold steady through the storms that shipwreck the vast majority of investors. The financial transformation you are about to undergo is not about learning a new stock-picking trick. It is about surgically removing the 90-day tumor from your brain and replacing it with the calm, clear vision of a 10-year investor. It is about understanding that the dizzying drops and euphoric spikes of the market are not the story itself, but merely the noisy, distracting footnotes to a much longer, much more important narrative of value creation. This is the story of how to build a fortress of patience in a world of anxiety, how to turn the market's panic into your profit, and how to harness the unstoppable force of time to achieve a level of wealth and financial freedom you may have never thought possible. This is the final promise of true long-term investing. Our journey begins not with a stock, but with a scandal. It's a story of deception, bankruptcy, and widespread panic that threatened to bring one of America's most trusted institutions to its knees. And it is here, in the heart of this crisis, that we find the first pillar of Buffett's long-term philosophy, the fortress of patience, the unshakable ability to weather the storm of market volatility. The year was 1963. The world was a canvas of Cold War tension and cultural revolution. In the world of finance, American Express was not just a company. It was a gold standard symbol of trust and stability. Its travelers' checks were as good as cash anywhere on the globe, and its credit card was a status symbol for the affluent. The company's stock was a blue chip in the truest sense, a bedrock holding for conservative portfolios and a staple of sound portfolio management. But beneath this veneer of invincibility, a rot was spreading. It originated in a subsidiary, a warehousing division that American Express had acquired. This division's largest customer was a small, unassuming company called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Anthony Tino DeAngelis. DeAngelis was a master of deception. He had devised a scheme of almost elegant simplicity. He would borrow massive sums of money, using his inventory of salad oil as collateral. The problem was, the salad oil didn't exist. His massive storage tanks in Bayonne, New Jersey, were mostly filled with water, with only a thin layer of oil floating on top to fool inspectors. He had created a phantom inventory worth over $175 million, the equivalent of over $1.5 billion today. In November of 1963, the House of Cards collapsed. Allied crude vegetable oil declared bankruptcy, and the truth of the great salad oil swindle came to light. The lenders who had extended credit against the non-existent oil were ruined. And because American Express's subsidiary had issued the warehouse receipts guaranteeing the collateral, American Express was on the hook. Wall Street was thrown into a state of absolute terror. The question on every investor's lips was chilling. Would American Express honor the claims? If they did, would the gargantuan liability bankrupt the company? If they didn't, would the world ever trust the American Express name again? The reputational damage seemed catastrophic. The stock, which had been trading at over $60 a share, was savaged. It plummeted by nearly 50%, dropping to $35. Analysts issued dire warnings. Brokers screamed, "Sell," to their clients. The herd, gripped by fear and uncertainty, was stampeding for the exits. This was the epitome of a temporary but terrifying headwind. In the midst of this chaos, a 33-year-old money manager from Omaha, Nebraska, saw not a disaster but a historic opportunity. Warren Buffett, running his small investment partnership, did not panic. He did not sell. He did the opposite. He began to investigate. He didn't just read the headlines. He did the grunt work that the panicked sellers on Wall Street couldn't be bothered to do. He went to restaurants and talked to cashiers. He visited banks and spoke with tellers. He wanted to understand one fundamental thing. Had the scandal damaged the core business? Was the fear in the stock market reflected in the real world of commerce? He found that people were still using American Express travelers' checks with unwavering confidence. Businesses were still proudly displaying the American Express Accepted Here sign. The core businesses, the travelers' checks and the credit card, were not just intact, they were thriving. The scandal was a massive, ugly problem for a single division, but it hadn't touched the company's true economic engine, its powerful brand moat. Buffett concluded that the market was making a classic mistake. It was confusing a temporary, survivable crisis in one part of the business with a mortal wound to the entire enterprise. He determined that the underlying value of the company's core operations was worth at least $60 per share, the price before the crisis. But now he could buy it for $35. He acted decisively. Buffett invested a staggering 40% of his partnership's assets, a sum of $13 million, into American Express stock. It was the largest investment he had ever made. He was betting the farm on his conviction that the market's short-term panic was profoundly irrational. Within a few short years, his thesis was proven spectacularly correct. American Express settled the claims, survived the scandal, and its core businesses continued to grow. The stock price not only recovered but soared to new heights. Buffett's $13 million investment turned into a $20 million profit. He hadn't just weathered the storm, he had used the storm's fury to purchase an incredible asset at a fraction of its true worth. This story is the quintessential illustration of the fortress of patience. It's the ability to stand firm, anchored by diligent research, while the hurricane of market emotion rages around you. It is the core of any successful long-term investing strategy. The behavior of Wall Street during the salad oil scandal is a textbook case of two powerful cognitive biases working in destructive harmony: myopic loss aversion and herd behavior. Understanding these deep-seated psychological principles is critical to building your own fortress of patience. Myopic loss aversion is a concept pioneered by behavioral economists Daniel Kahneman and Amos Tversky. It breaks down into two parts. Loss aversion is the well-documented phenomenon that for human beings, the psychological pain of losing is about twice as powerful as the pleasure of gaining. Losing $100 feels twice as bad as gaining $100 feels good. Myopic refers to our tendency to evaluate outcomes over very short time horizons. When you combine these, you get a recipe for disastrous investment decisions. An investor who checks their portfolio every day is constantly subjecting themselves to the small, painful stings of daily losses. Because the pain of those small losses is so acute, they are far more likely to make a rash decision, like selling, to stop the pain, even if the long-term prospects of their investment are excellent. During the American Express crisis, investors were myopically focused on the daily, terrifying headlines. The stock dropping from 60 to 50, then to 40, was a series of painful electrical shocks to their financial nervous system. Loss aversion kicked in, screaming, "Sell now! Make the pain stop before it gets worse." They weren't thinking about the value of the credit card business in 1970. They were thinking about the agony of losing another 5% of their capital by tomorrow. Buffett, by contrast, had a radically different time horizon. He wasn't evaluating the company based on the next day's stock price. He was evaluating the enduring strength of its business over the next 5 to 10 years. This long-term perspective acted as a psychological shield against myopic loss aversion. The short-term price drop wasn't a loss to be feared, but a price to be paid for a wonderful business. It was a temporary markdown, not a permanent impairment of value. The second bias, herd behavior, is the tendency for individuals to mimic the actions of a larger group, regardless of whether those actions are rational. In our evolutionary past, this was a survival mechanism. If everyone in the tribe suddenly starts running, it's probably wise to start running too and ask questions later. There might be a saber-toothed tiger nearby. In financial markets, however, this instinct is almost always catastrophic. When a stock like American Express begins to fall, the initial selling creates a signal. Other investors see the price dropping, and, fearing that the sellers know something they don't, they also sell. This creates more downward pressure, which in turn signals more people to sell. Soon, a stampede is underway, driven not by a rational analysis of the company's fundamentals, but by the primal fear of being left behind. The financial news media acts as a powerful accelerant for this herd behavior, with sensational headlines and breathless commentary amplifying the sense of panic and urgency. Wall Street in 1963 was a classic stampeding herd. The narrative was simple and terrifying. American Express is in trouble, everyone is selling, you should sell too before you lose everything. Buffett's genius was his ability to psychologically disconnect from the herd. His independent research served as an anchor. While the herd was reacting to the noise of other sellers, Buffett was listening to the signal from the real world, the cashiers and tellers who confirmed the business was fine. He was operating on facts while the market was operating on fear. Mastering your stock market psychology means consciously recognizing these two biases within yourself. It's about acknowledging that the urge to sell during a panic is a deeply ingrained, primitive instinct. Building a fortress of patience requires building systems to override that instinct. So how do you translate this from a story about a billionaire into a practical, applied mental model for your own wealth building? How do you construct your own fortress against the destructive psychological forces of the market? The blueprint consists of two key practices: the portfolio quarantine and the decision journal. The first practice, the portfolio quarantine, is a simple but profoundly effective system for combating myopic loss aversion. It's based on the understanding that the more frequently you look at your portfolio, the more likely you are to make an emotional, short-sighted decision. You must intentionally create friction and distance between yourself and the daily fluctuations of your investments. The first step is to delete the stock market apps from your phone. This is non-negotiable. Your phone is a device designed for instant gratification and constant stimulation. It is the enemy of long-term thinking. Having a real-time portfolio tracker in your pocket is like an alcoholic carrying a flask. It makes succumbing to temptation inevitable. The second step is to set a strict schedule for reviewing your portfolio. For a true long-term investor, checking in once a quarter is more than enough. For some, once or twice a year is even better. The goal is to shift your focus from the daily price to the long-term business performance. When you do review your holdings, you are not there to react to the price changes. You are there to answer a single question for each company you own. Has the long-term thesis for why I own this business been fundamentally broken? A bad quarter, a new competitor, or a recession are not reasons to sell. A fundamental breakdown would be something like a company losing its patent protection, a brand suffering irreparable damage, or a technological shift making its entire business model obsolete. This disciplined, infrequent review process starves myopic loss aversion of its fuel source, constant, painful feedback. The second practice, the decision journal, is your weapon against herd behavior and emotional reasoning. Before you ever buy a single share of a company, you will start a journal entry for it. In this entry, you will write down, in detail, the full investment thesis. You will answer a series of questions. 1. What is the business and how does it make money? 2. What is its durable competitive advantage, its moat? Why will this business be thriving in 10 years? 3. What are the primary risks to this business over the next decade? Be specific. 4. What is a conservative estimate of the business's intrinsic value? And what is my purchase price? What is the margin of safety? 5. Under what specific conditions would I sell this stock? Write down the exact scenarios that would invalidate your thesis. This process forces you to substitute rational, upfront analysis for the emotional, in-the-moment reactions that doom most investors. Now here's the crucial part. When the market inevitably panics and the stock you own drops 20, 30, or even 50%, and you feel that primal urge to join the herd and sell, you are forbidden from making a decision until you have first read your journal entry for that stock aloud. This simple act is a psychological circuit breaker. It yanks you out of the emotional, fear-driven part of your brain, the amygdala, and forces you back into the rational, analytical part, the prefrontal cortex. You will be confronted with the calm, clear-headed reasoning of your past self. You will reread the reasons you bought the company, its long-term strengths, and the specific reasons you decided you would sell. In almost every case, you will find that the reason the market is panicking is not one of the thesis-breaking conditions you wrote down. The market is panicking because of short-term fears, an earnings miss, a sector-wide downturn, a geopolitical event. Your journal will be the voice of reason, the ghost of your own sound judgment, reminding you to stay the course. It is your personal anchor in the storm, your foundation for the fortress of patience. This disciplined investment strategy is how you transition from gambling to owning, from speculation to true portfolio management. To truly appreciate the power of this approach, we must spend a moment examining its opposite. We must walk the path of the 99%, the path paved with anxiety, frustration, and ultimately, financial failure. This is the path of the short-term speculator, the individual who, lacking a fortress of patience, is a leaf in the wind of market sentiment. The journey for this individual begins with a fundamentally different mindset. They view the stock market not as a venue for owning fractional shares of great businesses, but as a giant casino. Their vocabulary is filled with the language of gambling, not business. They talk about playing the market, hot tips, and making a quick buck. Their research, if it can be called that, consists of scanning headlines on financial news websites, watching charismatic television personalities yell about the stock of the day, or, increasingly, scrolling through social media forums where anonymous accounts promise a rocket to the moon. They are not looking for durable competitive advantages. They are looking for momentum. They are not interested in balance sheets. They are interested in price charts. Their time horizon isn't a decade. It's the end of the week. Let's follow a typical trade. Our speculator hears a buzz about a certain technology company. It's in a hot sector, maybe artificial intelligence or electric vehicles. The stock has been on a tear, rising relentlessly for weeks. The fear of missing out, a powerful cousin of herd behavior, kicks in. They don't understand the company's technology, its competitive landscape, or its valuation. They just know that the price is going up, and they want in on the action. They buy the stock near its peak, feeling a rush of euphoria. They check their brokerage app 10, 20, 30 times a day. Every small uptick is a confirmation of their genius. Then, the inevitable happens. The company releases its quarterly earnings report, The numbers are good, but they're not quite as stellar as the whisper numbers on Wall Street. Perhaps revenue growth slowed from 50% to 45%. In the world of long-term business, this is a rounding error. In the world of short-term speculation, it is a catastrophe. The stock drops 10% in after-hours trading. Our speculators' euphoria turns to ice-cold dread. The next morning, the financial news is a chorus of negativity. Analysts are downgrading the stock. The headlines are dire. The social media forums are filled with panic and blame. Myopic loss aversion and herd behavior take complete control. The pain of the 10% loss is excruciating, and the overwhelming consensus of the herd is to sell. They capitulate. They sell their entire position, locking in a significant loss. Their primary emotional driver is a mix of regret and a perverse sense of relief. The relief that comes from stopping the pain, but the tragedy doesn't end there. A few weeks or months later, the short-term noise fades. The company continues to execute its long-term plan. It launches a new product, signs a major client. The next quarterly report is a blockbuster. The stock not only recovers its losses, but blasts off to new all-time highs. Our speculator watches from the sidelines, their capital depleted, their confidence shattered. They have managed to achieve the worst possible outcome. They bought high out of greed and sold low out of fear. This cycle repeats itself again and again with different stocks in different sectors, but the pattern is always the same. They are perpetually chasing performance, arriving late to the party and leaving early when the music stops for a moment. They are buying the market's enthusiasm and selling the market's fear, the exact opposite of the professional investor's mantra. Their portfolio is not a curated collection of assets compounding toward financial freedom. It is a chaotic churn of transactions, a graveyard of failed gambles, with the brokerage commissions and taxes paid on small wins eating away at what little capital remains. This is the path of the 99%. It is a path of constant stress, of being glued to a screen, of making life-altering financial decisions based on the fleeting emotions of a faceless crowd. It is the direct and predictable consequence of operating without a fortress of patience. The financial connection here is brutally direct and can be quantified with stark clarity. The difference between adopting Buffett's long-term time horizon and following the speculator's short-term path is the difference between geometric progression and painful arithmetic decay. Let's put some numbers to the American Express example. An investor who panicked and sold their shares at the low of $35 in 1963 locked in a massive loss. Let's say they had $10,000 invested. Their capital base would have shrunk to around $5,800, a 42% haircut. To get back to their starting point of $10,000, they would now need to achieve a staggering 72% return on their remaining capital, a very difficult feat. Many, demoralized, would simply give up on beating the market. Now consider Buffett's position, or the position of any investor who built a fortress of patience and held on. By 1967, just 4 years later, the stock was trading at $180 per share, a five-fold increase from the bottom. That initial $10,000 would have grown to over $51,000. But the true power of this long-term view is even more dramatic when you zoom out further. If that investor had simply held those shares and done nothing else, through recessions, market crashes, and periods of high inflation, their initial $10,000 investment, with splits and dividends reinvested, would be worth millions of dollars today. The short-term speculator sold to stop the pain of a $4,000 paper loss. The long-term investor held on and created multi-generational wealth. This is the tangible, life-altering financial consequence. Let's consider a more modern example. Imagine two investors in March of 2020, at the start of the global pandemic. Both own a simple S&P 500 index fund. The market is in free fall, dropping over 30% in a matter of weeks. The news is apocalyptic. The speculator, driven by myopic loss aversion and the screaming herd, sells everything. They move to cash, telling themselves they will wait for things to calm down and get back in later. The long-term investor, guided by their decision journal and portfolio quarantine rules, does nothing. They recognize that a global pandemic, while terrifying, does not invalidate the long-term thesis that hundreds of the world's best companies will continue to innovate, grow, and generate profits over the next decade. The speculator who sold in March 2020 saw the market bottom and then begin a ferocious rally. They were paralyzed by indecision. When should they get back in? Has it gone up too much already? They wait and wait and wait, and the market keeps rising. They likely only get back in a year later, buying the same assets they sold, but at a 30 or 40% higher price. They have permanently damaged their financial future. The patient investor, by simply holding, saw their portfolio fully recover within months, and then go on to reach new all-time highs. Their journey toward retirement planning and financial freedom continued, virtually uninterrupted. The direct financial connection is this: volatility is the price of admission for long-term returns. By selling during periods of volatility, the short-term speculator pays the price of admission but then leaves the theater before the movie starts. The long-term investor understands that the fee is non-refundable and sits through the scary parts, knowing that the story has a happy ending. This single principle, when applied with discipline, accounts for more of the wealth gap between successful and unsuccessful investors than any other factor. It is the master key to unlocking the fortune that the stock market creates over time. The second pillar of Buffett's long-term vision is perhaps the most famous, yet least viscerally understood concept in all of finance: the compounding engine. It is the recognition that time, not timing, is the true source of wealth. Albert Einstein is often apocryphally quoted as calling compound interest the eighth wonder of the world. Whether he said it or not, the sentiment is correct. It is a force of nature, a mathematical certainty that can either work for you or against you, building fortunes for the patient and creating debt prisons for the impatient. Buffett's entire career can be seen as an exercise in maximizing the amount of capital exposed to the power of compounding for the longest possible period of time. To understand how he internalizes this, we must travel to 1972 and examine a transaction that on the surface seemed to violate his own rules of value investing. This is the story of See's Candies. At the time, Buffett and his partner Charlie Munger were primarily known as cigar butt investors, following in the footsteps of their mentor, Benjamin Graham. They looked for statistically cheap companies, businesses trading for less than their liquidation value, the kind of ugly, unloved, but mathematically cheap stocks you could get one last puff out of before discarding. See's Candies was not a cigar butt. The company, a beloved West Coast producer of chocolates, was being sold by the See family. The asking price was $30 million. The company had about $8 million in tangible assets, things like factories and inventory. This meant that Buffett and Munger were being asked to pay a $22 million premium for intangible assets, things you couldn't touch or liquidate, like the company's brand name and customer loyalty. For the classic Graham-style value investor, this was heresy. Paying more than 2 times book value for a box of chocolates company seemed ludicrous. Buffett himself initially balked at the price. He offered $25 million, and the See family held firm at $30. It was Charlie Munger who pushed Buffett to evolve his thinking. Munger argued that they should not be asking, "What is this company worth if we liquidate it today?" but rather, "What is this company's earning power over the next 20 years?" See's Candies, Munger contended, was a different kind of asset. It had a secret weapon: pricing power. For decades, customers had happily paid a little more each year for See's chocolates, especially around holidays like Christmas and Valentine's Day. The brand was so strong, so ingrained in the culture of California, that customers didn't flinch at modest price increases. This ability to raise prices without losing business, combined with a product that required very little new capital investment to grow, meant that See's was a cash-generating machine. It was a business that could produce high returns on capital year after year, and those returns could then be reinvested elsewhere. Buffett and Munger realized they were looking at a, quote, franchise, a business with a durable competitive advantage that would allow it to compound its value for decades. They paid the $30 million. It was a pivotal moment in Buffett's career. It marked his transition from buying fair companies at wonderful prices to buying wonderful companies at fair prices. And the results were nothing short of breathtaking. Since that purchase in 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that profit was produced without requiring significant new capital. It was free cash flow that Buffett could then use to buy other businesses. The initial $30 million investment became a gusher of capital that fueled the growth of the entire Berkshire empire. See's Candies became Buffett's prototype for the perfect compounding machine. He learned that the initial purchase price, while important, was secondary to the long-term compounding ability of the business. A slightly higher price for a business that can grow its earnings at 15% per year for decades is infinitely better than a bargain price for a mediocre business that stagnates. The See's Candies story reveals the core of the compounding pillar. A long-term time horizon allows you to focus on the quality and durability of a business's earning power, not just its current statistical cheapness. It's about finding engines that can run on their own for a very long time, gathering speed and power with each passing year. The psychological principle that prevents most people from ever harnessing the power of compounding is known as hyperbolic discounting. This is a cognitive bias where people consistently choose smaller, immediate rewards over larger, later rewards. It's the reason people struggle to save for retirement, stick to a diet, or finish a long-term project. The future is an abstract concept, while the present is tangible and immediate. A donut today feels much more rewarding than the abstract goal of losing 10 pounds in 3 months. Similarly, a $500 profit from selling a stock today feels more real and gratifying than the abstract possibility of that stock being worth $50,000 in 30 years. Hyperbolic discounting is the enemy of every sound long-term investment strategy. It's the little voice in your head that whispers, "You've doubled your money on this stock in a year. That's a great return. You should sell now and lock in the profit. Who knows what could happen tomorrow?" This voice is incredibly seductive. It plays on our desire for immediate gratification and our fear of the unknown future. It makes us want to ring the register and turn a paper gain into real cash. The problem is that every time you ring that register, you kill the compounding process. You take your soldier out of the field. You chop down the sapling before it can grow into a mighty oak. When Buffett and Munger were considering See's Candies, the hyperbolic discounting instinct would have been to dismiss it. Why pay a $30 million price today for the promise of profits that would only materialize over many years and decades? The $22 million premium for goodwill felt like an immediate cost, while the future stream of earnings was a distant, uncertain benefit. Their ability to overcome this bias was rooted in their long time horizon. They were not discounting the future at the steep, hyperbolic rate that most people do. They were able to see the future stream of profits from See's as something tangible and highly probable, thanks to the company's strong brand and history. They were willing to trade the immediate gratification of finding a statistically cheaper stock for the much larger, deferred gratification of owning a superior long-term compounder. The entire get-rich-quick industry is built upon exploiting the public's tendency toward hyperbolic discounting. It promises immediate, massive returns, appealing to that deep-seated desire to have it all, right now. Whether it's day trading, penny stocks, or speculative cryptocurrencies, the allure is the same: the potential for a life-changing reward in a very short period of time. This is a psychological trap. True wealth building is almost always a slow, methodical, and even boring process. It's about planting seeds, not hunting for lottery tickets. To become a successful long-term investor, you must wage a conscious war against your own brain's preference for immediacy. You must learn to value the promise of a distant, larger reward more highly than the siren song of a small, immediate one. You must, in essence, learn to love the process of watching the paint dry, of letting the miracle of compound interest do its slow, silent, and unstoppable work. To make the power of compounding a tangible part of your financial life, you need an applied mental model that transforms it from an abstract theory into a concrete plan. This blueprint is called the Freedom Fund Projection, and it's a powerful exercise that uses the math of compounding to give you a clear, motivating vision of your financial future. First, you need a tool. This can be a simple spreadsheet or an online compound interest calculator. The tool itself doesn't matter. The process of using it is what counts. You will need 4 inputs: your initial investment, your starting capital, your monthly contribution, what you can consistently add, your expected annual rate of return, and your time horizon in years. Let's walk through the steps. Step 1. Define your starting point. Be honest about what you have to invest right now. Let's say it's $10,000. This is your initial investment. Step 2. Determine your consistent contribution. Look at your budget and find an amount you can realistically commit to investing every single month without fail. This is even more important than the starting amount. Let's say it's $500 a month. Step 3. Choose a realistic rate of return. This is not a place for fantasy. A conservative and historically achievable target for a diversified portfolio of stocks, like an S&P 500 index fund, is between 8 and 10% per year over the long run. Let's use 8% for our projection. Step 4. Set your time horizon. This is where you must stretch your mind. Don't think about next year. Think in decades. Let's create projections for 10, 20, and 30 years. Now, you run the numbers. After 10 years, your initial $10,000 plus your $500 a month at an 8% return would grow to approximately $108,000. You would have contributed $70,000, and the market would have generated $38,000 for you. A good start. After 20 years, that same process results in a portfolio worth $349,000. You contributed $130,000, and the compounding engine generated $219,000 for you. Notice how the growth is starting to accelerate. The earnings are now significantly larger than your contributions. Now for the magic. After 30 years, your portfolio would be worth $822,000. You contributed a total of $190,000 over 3 decades. The compounding engine, the 8th wonder of the world, generated a staggering $632,000 for you. Your money is now making far more money each year than you are contributing. This is the crossover point. This is financial momentum. Do this exercise for yourself, with your own numbers. Print out the 30-year projection. This is your freedom fund. Put it somewhere you will see it every day, on your bathroom mirror, on your desk. This document is your shield against hyperbolic discounting. When you are tempted to sell a winner to lock in a small gain, look at your projection. You'll see that the real prize is not the small gain today, but the massive, life-altering sum that awaits you if you just let the engine run. When you are tempted to splurge on an expensive item you don't need, look at your projection and ask, is this purchase worth more than the future freedom this money could buy me? This projection transforms retirement planning from a vague, distant chore into an exciting, quantifiable mission. It gives you a clear vision of the massive reward that awaits your patience, making it easier to overcome the brain's natural desire for immediate but ultimately insignificant gratification. It is the practical application of a long-term time horizon, the blueprint for turning time itself into your most valuable financial asset. The antithesis to the compounding mindset is the path of the churner. This is the investor who is perpetually active, believing that the key to wealth is constant buying and selling, always trying to catch the next hot wave. Their portfolio has a high turnover rate, resembling a busy train station more than a well-tended garden. This path is seductive because it feels productive. The churner is always doing something, reading news, analyzing short-term charts, placing trades. This activity creates the illusion of control and expertise. They believe they are cleverly navigating the market, when in reality they are their own worst enemy, systematically destroying the compounding process before it can ever begin. Let's follow the churner's journey with a great company. Say, a business like Microsoft. They buy the stock in 2013, recognizing its potential in cloud computing. Over the next 2 years, the stock does very well, rising by 50%. The churner, governed by hyperbolic discounting, decides this is a fantastic return and sells to lock in the gains. They feel smart. They have beaten the market over that short period. They take their profits and now have a new problem: what to do with the cash. They start searching for the, quote, next Microsoft. They find another promising company and invest. This new company, however, doesn't work out as well. Maybe it's a good company in a difficult industry, or maybe their timing was just off. The stock goes sideways for a year. Frustrated, the churner sells it for a small loss and moves on to the next idea. Meanwhile, what happened to Microsoft? It continued its inexorable growth, driven by the dominance of its Azure cloud platform. The 50% gain the churner was so proud of was just the first few steps of a marathon. The stock would go on to increase by another 1,000% over the next decade. The churner's small, locked-in profit pales in comparison to the life-changing fortune they would have had by simply doing nothing. The churner's mistakes are threefold. First, they systematically cut their winners short. They sell the very companies that are the powerful compounding engines capable of driving their entire portfolio's returns. A common finding in portfolio management studies is that the vast majority of long-term returns come from a very small number of superstar stocks. By selling these superstars early, the churner guarantees a mediocre result. Second, they incur massive transaction costs and taxes. Every time they sell a winning stock, they have to pay capital gains tax, immediately reducing the amount of capital they have available to reinvest. Their brokerage firm loves them, as they are constantly generating commissions, but they are fighting an uphill battle, giving away a slice of their principal with every smart move they make. A long-term buy-and-hold investor defers those taxes for decades, allowing 100% of their capital to continue compounding. Third, the churner is constantly forced to be right twice. They have to be right about when to sell the first company and when to buy the second. This is an impossibly difficult task to repeat successfully over time. The long-term investor only has to be right once about the enduring quality of the business they initially buy. The path of the churner is a frantic, expensive, and ultimately futile dance. It is a rejection of the most powerful force in finance. They are like a gardener who pulls up their carrots every week to see how they're growing, wondering why they never harvest anything substantial. They failed to grasp the simple, profound truth that lies at the heart of the See's Candies story. The greatest fortunes are not made by brilliant traders, but by patient business owners who allow the magic of compound interest to work, uninterrupted, for a very long time. The direct financial connection between a long-term time horizon and the power of compounding is the most dramatic and important in all of personal finance. It is the mathematical engine that turns modest savings into true wealth. Let's quantify this with an example that every person planning for their future should burn into their memory. Consider two investors, both starting at age 25. Investor A, we'll call her the patient planner, invests $5,000 every year into a simple stock market index fund. She does this for just 10 years, from age 25 to 35. At age 35, she stops contributing completely. She has invested a total of $50,000. She then lets that money sit and compound untouched until she retires at age 65. Investor B, the late starter, doesn't begin investing until age 35, the exact moment the patient planner stops. He also invests $5,000 a year, but he does it every single year for 30 years, from age 35 until he retires at age 65. He has invested a total of $150,000, 3 times as much as the patient planner. Assuming a 10% annual rate of return for both, who has more money at age 65? The answer is staggering. The late starter, despite investing 3 times as much money over a much longer period, ends up with approximately $1,106,000, a fantastic sum. But the patient planner, who only invested for 10 years at the very beginning, ends up with $1,396,000. She has nearly $300,000 more, despite investing $100,000 less. Why? Because her capital had an extra 10 years to compound. Those first 10 years were exponentially more powerful than the later years, because they formed the foundation upon which all future growth was built. Time, not the total amount invested, was the decisive factor. This is the tangible financial power of starting early and thinking long-term. On a corporate balance sheet, this principle manifests as retained earnings. A great compounding business like See's Candies doesn't need to spend all its profits just to maintain its operations. It generates excess cash or retained earnings year after year. A brilliant capital allocator like Buffett can then take these retained earnings and reinvest them at high rates of return, either in the business itself or by acquiring other businesses. This creates a flywheel effect. The profits from the original business fund the purchase of a new business, which in turn generates its own profits, which are then available for further acquisitions. This is how the Berkshire Hathaway empire was built, on the back of the compounding power of the retained earnings from its wholly owned subsidiaries. For your personal portfolio, this directly relates to the concept of dividend reinvestment. When you own a stock or an ETF that pays a dividend, you have a choice. Take the cash or automatically reinvest it to buy more shares. The short-term thinker takes the cash. The long-term compounder always reinvests. Reinvesting dividends is like pouring gasoline on the fire of compound interest. Each new share you buy with the dividend then generates its own dividends, creating a compounding effect on top of the price appreciation of the stock itself. This is how you achieve the exponential growth curve seen in the example of the patient planner. The financial connection is clear. A long-term time horizon is the non-negotiable prerequisite for unlocking the power of compound interest. It is the key that turns a linear process of saving into an exponential process of wealth building. To truly adopt the time horizon of a business owner, we must move beyond viewing our investments as mere flickering symbols on a screen. This brings us to the third crucial pillar, the business owner's mindset. This is the mental leap from seeing a stock as a ticker symbol, like MSFT or AAPL, to seeing it as a fractional ownership stake in a living, breathing enterprise. When you own a stock, you are a part owner of that company. You are entitled to your share of its future profits. This may sound like a simple semantic shift, but it has profound implications for your investment behavior and, most importantly, your time horizon. There is no better illustration of this principle in Warren Buffett's career than his investment in the Washington Post Company in 1973. This was not a quick trade. It was a relationship with the business that lasted for decades and became a cornerstone of his legend. In the early 1970s, the stock market was in a foul mood. The Nifty 50 bubble had popped, and investors were pessimistic. The Washington Post Company, which owned the eponymous newspaper, Newsweek magazine, and several television stations, saw its stock price pummeled. The entire company had a market capitalization of around $80 million. Buffett, as was his habit, dug into the business. He didn't just look at the stock chart, he looked at the enterprise itself. He estimated what a rational, private buyer would pay for each of the company's assets if they were sold off separately. He calculated that the television stations alone were worth more than the entire $80 million price tag the market was putting on the company. This meant that in buying the stock, he was essentially getting the world-famous Washington Post newspaper and Newsweek magazine for free. More importantly, he recognized the unique competitive position, the moat, of the newspaper. In a pre-internet era, the leading newspaper in a major city was an economic fortress. It had a virtual monopoly on local advertising and was the primary source of information for its community. It was a fantastic business, and the market was giving it away. So Buffett began to buy. He invested over $10 million, acquiring more than 10% of the company. He wasn't buying a ticker symbol, WPO. He was becoming a significant part owner of a collection of high-quality media assets run by a family he trusted, the Grahams, particularly the formidable Katharine Graham. And then, he held. He held through the Watergate scandal, when the newspaper's journalism shook the foundations of American politics. He held through recessions. He held through periods when Wall Street soured on newspaper stocks. He held through thick and thin for over 40 years. Why? Because he wasn't a speculator betting on the stock price. He was a business owner, invested in the long-term success of the enterprise. Think about it this way. If you own the local pizzeria in your town, and it had one bad quarter because of a new competitor opening up nearby, would you immediately sell the entire business? Of course not. You would focus on the long term. You would innovate, improve your service, and compete. You would think like an owner, not a flipper. Buffett's perspective on the Washington Post was the same. He was on the board of directors. He advised Katharine Graham. He was involved. He was a partner in the business. That $10 million investment, through the power of compounding and the enduring strength of the business, eventually grew to be worth over $1 billion. It was one of the single greatest investments of all time. This staggering return was only possible because he adopted the mindset of a business owner. A speculator would have sold in 1974 during the market crash. A short-term trader would have sold after the stock doubled. Only a true owner, someone who sees their stock certificate as a deed to a piece of a real business, has the psychological fortitude to hold on for the decades required to achieve such a result. The psychological trap that prevents the business owner's mindset is a combination of two potent biases: the affect heuristic and the representativeness heuristic. These mental shortcuts cause us to react to superficial symbols rather than analyze the underlying substance. The affect heuristic is our tendency to make judgments based on our immediate emotional response, our gut feeling, rather than a rational analysis. When we see a stock ticker symbol, it isn't just letters on a screen. It comes loaded with emotional baggage. We might associate it with a news headline we just read, a positive or negative experience with one of its products, or the general mood of the market that day. If the market is down and the ticker is red, our affect, our emotional response, is negative. This triggers a feeling of danger and a desire to sell. Conversely, if the stock is soaring and the ticker is green, we feel euphoria and a desire to buy more, often driven by greed. This emotional decision-making process is the polar opposite of how a rational business owner thinks. A business owner doesn't make decisions about their company based on a fleeting mood. They base them on financial statements, competitive positioning, and long-term strategic plans. Buffett's analysis of the Washington Post was a purely intellectual exercise, detached from the market's gloomy affect. He wasn't reacting to the scary red numbers on the stock ticker. He was coolly calculating the intrinsic value of the company's assets. He was overriding his emotional gut reaction with a logical, business-like assessment. The representativeness heuristic is our tendency to make judgments by comparing a situation to a mental prototype or stereotype. In investing, this often means we judge a stock based on its recent price action. If a stock's price has been going down, we classify it as a, quote, loser. If it has been going up, we classify it as a winner. We then extrapolate this recent past into the future, assuming the trend will continue. This is why so many investors buy high and sell low. They buy stocks that have recently performed well, representing a winner, and sell stocks that have recently performed poorly, representing a loser. This is mistaking the stock's price for the business's value. The business of the Washington Post in 1973 was getting stronger, even as its stock price was getting weaker. The market's representation of the company was a loser stock in a downtrodden sector. But Buffett ignored this superficial representation and looked at the reality of the underlying business, which was a, quote, winner with a dominant market position. Adopting the business owner's mindset is the active process of fighting these two biases. It requires you to consciously separate the business from its stock. The business is the collection of people, assets, and brands that generates cash flow. The stock is a claim on that cash flow, whose price is determined daily by the erratic, emotionally driven whims of millions of strangers. Your job is to focus on the former and take advantage of the latter. This is a core tenet of value investing and a prerequisite for developing a true long-term time horizon. You cannot hold a business for decades if your opinion of it changes with the daily mood swings of the market. To install the business owner's mindset into your own investment process, you need a practical blueprint, a checklist that forces you to think like an owner before you ever deploy a single dollar of capital. This is the private owner's checklist. Before you buy any stock, you must be able to answer these 5 questions in writing, as if you were preparing a proposal to buy the entire company, not just a few shares. Question 1. Can I explain this business to a 10-year-old in 2 minutes? This is the ultimate test of your understanding. If you cannot simply and clearly articulate what the company does, how it makes money, and who its customers are, you have no business owning it. This immediately eliminates investments in companies with overly complex financial structures or technologies that are outside your circle of competence. A true owner knows their business inside and out. Question 2. What is this company's moat, and is it widening or shrinking? A moat is a durable competitive advantage that protects a business from competitors, just as a moat protects a castle. It could be a powerful brand name like Coca-Cola, a network effect like Facebook, high switching costs for customers like Microsoft Windows, or a low-cost production advantage like Geico. You must identify the specific moat and, crucially, make a judgment on whether that moat is getting stronger or weaker over time. A business owner is obsessed with protecting and expanding their moat. Question 3. Is this a business I would be happy to own if the stock market shut down for 10 years? This is the ultimate litmus test for a long-term time horizon. If the stock market closed, you would receive no price quotations. You couldn't sell. Your only return would be your share of the company's actual profits, likely paid out as dividends. Would you still be comfortable owning this business based solely on its ability to generate cash over the next decade? This question forces you to completely separate the underlying business from its fluctuating stock price. Question 4. Does the management team think and act like owners? A business owner carefully scrutinizes who they hire to run their company. As a shareholder, you are hiring the CEO and the executive team. You must study their track record. Do they have a history of intelligent capital allocation? Do they communicate with shareholders in a clear and honest way? Read their annual letters to shareholders. Do they have significant personal wealth invested in the company's stock, aligning their interests with yours? You are looking for partners, not hired guns. Buffett's trust in Katharine Graham was a key part of his Washington Post investment. Question 5. Does the current market price offer a significant discount to a conservative estimate of the company's intrinsic value? This is the margin of safety principle. A business owner never wants to overpay for an asset. You must perform a simple valuation. You don't need a complex financial model. You can look at the company's historical earnings and apply a reasonable multiple or estimate its future cash flows. The goal is to arrive at a conservative estimate of what the whole business is worth, and then demand to buy your small piece of it at a significant discount to that value. This provides a buffer against errors in judgment or bad luck. By forcing yourself to go through this 5-step checklist before every investment, you fundamentally change your relationship with the market. You are no longer a speculator chasing tickers. You are a thoughtful proprietor, carefully acquiring pieces of high-quality enterprises that you understand and want to partner with for the long term. This is the bedrock of a sound investment strategy and the only way to build lasting wealth. The antithesis of the business owner's mindset is the ticker-tape renter. This individual doesn't see themselves as an owner of anything. They are merely renting stocks for a short period, hoping the price goes up so they can sell them to someone else at a higher price. This is the essence of the greater fool theory of investing. Their entire focus is on the stock's price, not the business's value. The ticker-tape renter's day is a blur of charts, technical indicators, and financial news chatter. They are obsessed with things like moving averages, trading volume, and support and resistance levels. They believe they can predict the short-term direction of a stock's price by analyzing its past movements. They are trying to divine the psychology of the crowd, not the economics of the business. Let's imagine the ticker-tape renter looking at the Washington Post in 1973. They would have seen a stock chart that looked like a falling knife. All their technical indicators would be screaming sell. The moving averages would be trending down, and the stock would have broken through every level of support. They would see a stock in a hated industry, with overwhelmingly negative sentiment. Their conclusion would be swift and certain. This is a stock to be avoided at all costs, or perhaps even shorted, betting on its price to fall further. They would not have spent a single moment analyzing the value of the television stations or considering the monopolistic power of the newspaper. The concept of intrinsic value is foreign to them. The only value is the last price someone else was willing to pay. This approach is fraught with peril. By focusing only on price, the ticker tape renter is always reacting, never anticipating. They are at the mercy of the market's manic depressive mood swings. They are doomed to buy after a stock has already had a big run-up because the chart looks positive, and sell after it has fallen because the chart looks negative. They are perpetually late. Furthermore, this mindset completely ignores the ultimate source of all stock market returns: the earnings and cash flow generated by the underlying businesses. Over the long run, a stock's price will inevitably follow the trajectory of its business's earnings power. A company that consistently grows its profits will eventually see its stock price rise, regardless of short-term sentiment. A company with deteriorating fundamentals will eventually see its stock price fall, no matter how much short-term hype surrounds it. The ticker tape renter is trying to predict the wiggles on the graph while ignoring the powerful, underlying economic engine that is ultimately driving the entire machine. They are focused on the shadow, not the object casting it. It's a stressful and ultimately losing game. It requires one to be a master market psychologist, a brilliant chartist, and to have impeccable timing over and over again. Being a successful business owner, by contrast, only requires one to correctly identify a great business and then have the patience to hold on. The former is a path to anxiety and likely failure. The latter is a proven, methodical path to financial freedom. The direct financial connection of the business owner's mindset is the profound difference in returns generated by owning high-quality businesses versus trading speculative stocks. This difference is not linear. It is exponential over time. Let's quantify this by comparing two hypothetical investment approaches over a 20-year period. On one hand, we have the business owner's portfolio. This investor uses the private owner's checklist to buy a concentrated portfolio of 10 to 15 wonderful companies with durable moats, bought at reasonable prices. They make very few changes to this portfolio over 2 decades, only selling if a company's long-term fundamentals truly deteriorate. On the other hand, we have the ticker tape renter's portfolio. This investor actively trades, holding 50 to 100 different stocks over the same 20-year period. They are chasing momentum, buying what's hot and selling what's not, with an average holding period of less than a year. The financial results will be starkly different for several quantifiable reasons. First, return on equity. The business owner's portfolio, by its very nature, will be filled with companies that generate a high return on equity, ROE, a key measure of profitability. A high ROE means the company is very effective at taking the shareholders' capital and generating profits from it. Over time, a stock's return is highly correlated with the underlying business's ROE. The ticker tape renter's portfolio is likely to have a much lower average ROE, as they are focused on price momentum, not business quality. Second, the impact of taxes and transaction costs. The business owner pays very little in taxes over the 20 years, as they rarely sell. Their capital is allowed to compound on a pre-tax basis. The ticker tape renter, by contrast, is a walking tax generation machine. If they are successful, a significant portion of their gains are skimmed off the top each year by the government and their broker, severely crippling their long-term compounding rate. A 20% annual return can easily be knocked down to a 15% net return after accounting for the friction of taxes and trading costs. Over 20 years, this difference is colossal. A $100,000 investment compounding at 20% becomes $3.8 million. At 15%, it becomes only $1.6 million. The churn has cost the renter over $2 million. Third, the fat tail effect. Long-term market returns are dominated by a small number of massive winners. By buying and holding a portfolio of quality businesses, the business owner ensures they are on board for the entire ride when one of their companies becomes a mega winner, like Buffett's Washington Post. The ticker tape renter is almost certain to have sold that mega winner years before it reached its full potential, in order to lock in a small short-term gain. They will own 100 lottery tickets that paid out $10, while the business owner held the one that hit the jackpot. The ultimate financial connection is this: the business owner's mindset naturally leads you to own the types of companies that create astronomical wealth over the long term, and provides the psychological fortitude to hold them long enough to realize that wealth. The ticker tape renter's mindset leads you to churn through mediocre ideas, racking up costs and taxes, and ensures you will sell the big winners far too early. It is the financial difference between being the house and being the gambler. A long time horizon is not merely a defensive shield, it is also a powerful offensive weapon. This brings us to the fourth pillar of Buffett's philosophy, the opportunity of pessimism. This is the ability to use the market's short-term panic as a long-term buying signal. For the true long-term investor, market crashes, recessions, and periods of extreme fear are not threats to be avoided, but rare and wonderful opportunities to acquire great businesses at bargain prices. There is no more dramatic example of this than Warren Buffett's actions during the absolute darkest days of the 2008 financial crisis. The fall of 2008 was a period of existential terror for the global financial system. Lehman Brothers, a 158-year-old investment bank, had just declared bankruptcy. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. There was a genuine, palpable fear among the highest levels of government and finance that the entire system was on the verge of a complete and total collapse. The stock market was in a state of free fall. The dominant emotion on Wall Street was not greed, but pure, unadulterated fear. In this environment, most investors were stampeding for the exits, selling everything that wasn't nailed down, and fleeing to the perceived safety of cash and government bonds. Into this maelstrom of panic stepped Warren Buffett not as a seller, but as a buyer. He was not just buying common stocks, he was acting as a lender of last resort to some of the most iconic names in American capitalism, structuring deals that were almost unfathomably brilliant. On September 23, 2008, he announced a $5 billion investment in Goldman Sachs, one of the most prestigious investment banks in the world, whose stock was being hammered. This was not a simple stock purchase. Buffett bought $5 billion of perpetual preferred stock that paid him a 10% dividend per year. That's $500 million in cash every year, guaranteed. On top of that, he received warrants giving him the right to buy another $5 billion worth of Goldman's common stock at a fixed price for the next 5 years. Essentially, he was being paid handsomely to wait, and if the company recovered, he stood to make billions more on the stock itself. Just a few weeks later, he struck a similar deal with General Electric, another American icon on the ropes, investing $3 billion on similarly favorable terms. In 2011, with the European debt crisis rattling markets, he did it again, investing $5 billion in Bank of America. These were not just investments, they were powerful signals to the market. At a time when no one else would lend, Warren Buffett, with his unimpeachable reputation, was stepping up and declaring that these foundational American institutions were sound and would survive. He was, in his own words, being greedy when others are fearful. He could only do this because of his long-term time horizon. He wasn't worried about whether Goldman Sachs' stock would be lower next month or next quarter. He was making a judgment about the enduring power and profitability of these institutions over the next 5, 10, and 20 years. He knew that in a capitalist society, great financial institutions and industrial companies were essential, and that the government would ultimately not allow them to fail. The market, in its short-term panic, had lost all perspective. It was pricing these companies as if their demise was imminent. Buffett, with his calm long-term outlook, was able to see through the terrifying headlines to the underlying durable value. The results were spectacular. Berkshire Hathaway made billions from these deals. The 10% dividends gushed cash into Berkshire's coffers for years. When the crisis passed and the stock prices recovered, he exercised his warrants, generating billions more in capital gains. It was a masterclass in opportunistic long-term investing. He had used the market's extreme short-term fear as the basis for creating a decade's worth of extraordinary returns. The psychological principle that creates these incredible opportunities is a powerful combination of the availability cascade and fear contagion. Understanding this social and psychological dynamic is key to being able to stand apart from the crowd and act rationally when everyone else is losing their minds. The availability cascade is a self-reinforcing cycle where a collective belief gains more and more plausibility through its increasing repetition in public discourse. A relatively minor event can be magnified by the media, and the resulting public attention can lead to widespread panic and governmental action. In 2008, the bankruptcy of Lehman Brothers was the trigger. The story was dramatic, simple, and terrifying. The media, in its 24/7 news cycle, repeated this story endlessly, focusing on the most dramatic images: employees leaving the Lehman offices with their boxes, panicked traders on the floor of the stock exchange. This constant repetition made the idea of a total financial collapse available in everyone's mind. It started to feel not just possible, but probable, even inevitable. Each news report and panicked conversation reinforced the narrative, making people more and more certain of impending doom. This is the cascade effect. A belief becomes more believable simply because it is being repeated by more and more people. Fear contagion is the emotional component of this process. Fear, like a virus, is highly contagious, especially in situations of uncertainty. When we see others panicking, it triggers a primal response in our own brains. It's the same mechanism as herd behavior, but amplified by a life-or-death emotional charge. In 2008, the fear was palpable. You could hear it in the voices of financial commentators, see it in the faces of politicians, and feel it in the market's violent downward lurches. This emotional contagion bypasses our rational thought processes. It makes it incredibly difficult to step back and analyze the situation objectively. The fear screams, "Get out now, survive." It doesn't allow for the calm, probabilistic thinking required for good investment decisions. Warren Buffett's mind appears to be uniquely insulated from these two forces. His long-term time horizon acts as a natural firebreak against the availability cascade. He isn't focused on the endlessly repeated, terrifying story of the day. He is focused on the long-term history of American capitalism, a history filled with panics, recessions, and wars, all of which were eventually overcome. He places the current crisis in its proper historical context, which immediately deflates its perceived severity. His insulation from fear contagion comes from his internal scorecard. Most people judge their decisions based on whether others agree with them, an external scorecard. If everyone is selling, selling feels like the right thing to do. Buffett operates on an internal scorecard. He judges his decisions based on his own research and his own assessment of a business's intrinsic value. The fact that everyone else disagrees with him is not a source of fear, but a source of excitement. It is the very signal that a historic opportunity may be at hand. To be greedy when others are fearful, you must first build the psychological defenses to be rational when others are hysterical. This means consciously inoculating yourself against the availability cascade by seeking out historical context and avoiding the echo chamber of sensationalist news, and developing an internal scorecard based on your own diligent research, freeing yourself from the need for the crowd's approval. So how do you turn this principle into an actionable blueprint for your own investment strategy? You can't just wait for a crisis and hope you have the courage to act. You need to prepare. The applied mental model for this is the panic shopping list. This is a pre-prepared list of wonderful companies that you would love to own, but whose stocks are currently too expensive. It is a tool of preparation that allows you to substitute rational, premeditated action for emotional, in-the-moment reaction during a market crash. The process is simple, but requires discipline. Step 1. Identify your dream companies. During periods of market calm and even euphoria, you will do your research. Using the business owner's checklist, you will identify a list of 10 to 20 truly exceptional businesses. These are the companies with the widest moats, the best management teams, and the most durable long-term prospects. Think of companies that have dominated their industries for decades, the undisputed leaders. Step 2. Value them and set your price. For each of these companies, you will do a conservative valuation. You will determine what you believe the business is truly worth on a per-share basis. Then you will determine your panic price, the price at which the stock would be an absolute bargain, a price so low it seems almost impossible today. This might be 30, 40, or even 50% below the current market price. Write these prices down. This is your shopping list. You now have a concrete plan. If company X falls to price Y, I will buy. Step 3. Build your panic powder. You cannot go shopping during a sale if you have no cash. A crucial part of this strategy is to always have some portion of your portfolio in cash or short-term bonds, ready to be deployed. This is your dry powder. In a roaring bull market, holding cash will feel foolish. It will be a drag on your returns. You must have the discipline to see it not as a non-performing asset, but as call options on future bargains with no expiration date. This is your opportunity fund. Step 4. Wait for the storm. Market panics are inevitable. They happen every few years. When the next one arrives, and it will, the world will look like it's ending. The headlines will be terrifying. The availability cascade and fear contagion will be in full effect. Your friends and family will be panicking. Your own gut will be screaming at you to sell. This is the moment of truth. Instead of panicking, you will pull out your panic shopping list. You will look at the predetermined prices you set when you were calm and rational. You will see that some of these world-class companies are now trading at or below your panic prices. Your course of action is now simple. You are not making a difficult emotional decision in the heat of the moment. You are simply executing a plan you made long ago. You will deploy your panic powder and start buying these incredible businesses at prices you once only dreamed of. This proactive, prepared approach is the single biggest difference between amateur and professional investors. Amateurs react to crises. Professionals prepare for them. The panic shopping list transforms a market crash from a terrifying threat into the investment opportunity of a lifetime. It is the practical tool that allows you to be the calm, rational buyer in a world of hysterical sellers. The antithesis of this opportunistic approach is, tragically, the most common behavior among individual investors, selling the bottom. This is the investor who, lacking a plan and a long-term perspective, allows the market's fear to become their own. Their journey through a market crash is a predictable and painful one. In the early stages of the downturn, they are in denial. They tell themselves it's just a healthy correction, and that things will bounce back soon. They hold on, but with a growing sense of anxiety. As the decline accelerates, anxiety turns to fear. The media narrative becomes overwhelmingly negative. Their portfolio is bleeding value every day. Myopic loss aversion is now in full control, and the pain is intense. They start to think, I just want to get back to even. Finally, the market reaches a point of capitulation. This is the moment of maximum pessimism, when it feels like the decline will never end. A final, violent lurch downwards breaks our investors' will. The fear becomes unbearable. They can't take the pain anymore. Convinced that the market is going to zero, they sell everything. They dump their entire portfolio of stocks at the worst possible prices, often on the very day of the market bottom. The moment they sell, they experience a strange sense of relief. The pain has stopped. They feel they have protected themselves from further losses. But this relief is short-lived. What they have actually done is turn a temporary paper loss into a permanent, catastrophic loss of capital. And now, just like the speculator who sells a winning company after a bad quarter, they are faced with the impossible question: when to get back in. The market, having purged the last of the panic sellers, often begins to recover with surprising speed. But our investor, now scarred by the experience, is skeptical. They see the recovery as a dead cat bounce, a false dawn. They wait for the market to fall again to prove them right. But it doesn't. It keeps climbing. The prices of the stocks they sold are now 10, then 20, then 30% higher than where they sold them. The pain of their mistake is now compounded by the agony of regret. They are frozen, watching from the sidelines as the new bull market takes off without them. Eventually, often a year or two later, when the bull market is well established and the economic news is universally positive again, they finally feel safe enough to get back into the market. They end up repurchasing the same assets they sold in a panic, but at prices that are 50% or even 100% higher. They have perfectly executed the strategy of buy high, sell low. This behavior is the single most destructive thing an investor can do to their long-term wealth. It is the polar opposite of Buffett's approach. Instead of using the market's pessimism as an opportunity, they allowed the market's pessimism to crystallize their losses and lock them out of the subsequent recovery. This is the path of the 99%, a path of fear-driven reaction that ensures they will never achieve their goals of wealth building and financial freedom. The direct financial connection here is the enormous wealth transfer that occurs during market panics. It is a transfer from the impatient to the patient, from the reactive to the prepared. The financial impact of selling at the bottom is not just the immediate loss, it's the permanent impairment of your long-term compounding potential. Let's quantify it. An investor with a $500,000 portfolio in October 2007 saw it decline to around $250,000 by the bottom in March 2009. A 50% loss. The investor who panicked and sold at the bottom locked in that $250,000 loss. To get back to their original $500,000, they now need to achieve a 100% return on their remaining capital, a monumental task. The investor who had a long-term time horizon and simply held on, doing nothing, saw their portfolio fully recover by 2012 and then continue to grow to over $1 million in the following decade. But the real winner was the prepared opportunist, the investor with a panic shopping list and dry powder. Let's say they started with the same $500,000, but held $100,000 in cash. Their $400,000 in stocks fell to $200,000. At the bottom, they deployed their $100,000 in cash. Their portfolio value was now $300,000. But because they bought at generational lows, their portfolio roared back with incredible force. They would have recovered their initial $500,000 much faster than the investor who simply held, and their portfolio would have grown to a significantly larger sum over the next decade. The deals Buffett did in 2008 provide a stark, real-world example. His investment in Goldman Sachs paid him a guaranteed $500 million per year in dividends. That's a 10% cash return in a world where interest rates were heading to zero. By 2013, he had sold a portion of his stake for a $1.4 billion profit and still held shares worth billions more. The total return on that single crisis-era investment was astronomical. This is the financial manifestation of the principle. Market panics don't destroy value, they simply mark it down. The underlying businesses still exist, their factories are still operating, and their brands still have power. The panic is a temporary crisis of confidence, not a permanent destruction of economic capacity. The long-term investor who understands this can step in and purchase future earnings streams at a fraction of their true worth. The wealth transfer is not a matter of luck or genius-level insight. It is a simple, predictable outcome of two different time horizons colliding. The short-term speculator, focused on the next 90 days, sees only risk and sells at any price to escape. The long-term investor, focused on the next 90 months, sees only opportunity and buys with both hands. The financial world is a battlefield, and a long-term time horizon is the heaviest armor and the sharpest sword. This brings us to our fifth and final pillar, a concept that acts as a crucial filter for a long-term time horizon, the circle of competence. You cannot confidently hold an investment for a decade if you do not deeply understand the business and the industry in which it operates. A long-term time horizon is sustainable only when it is built on a foundation of genuine knowledge. The principle is simple. Every investor has a set of subjects they know well. This could be banking, retail, software, or energy. This area of deep knowledge is their circle of competence. Success in long-term investing comes not from having a giant circle, but from knowing the perimeter of your circle and staying strictly within it. Warren Buffett is famous for his adherence to this rule, and the most telling example is his behavior during the dot-com bubble of the late 1990s. The late 90s were a period of wild euphoria for technology stocks. Companies with no profits and often no revenue were going public and seeing their valuations soar to billions of dollars overnight. It was a new paradigm, the market screamed. Old metrics like earnings and book value were irrelevant. It was all about eyeballs, network effects, and getting big fast. During this frenzy, Warren Buffett and Berkshire Hathaway were famously on the sidelines. They did not participate. They continued to buy boring, understandable businesses like insurance companies, furniture stores, and utilities. As a result, Berkshire's performance lagged the soaring NASDAQ index for several years in a row. The criticism was relentless. Magazine covers declared him a has-been. Pundits claimed the old man from Omaha had lost his touch, that he didn't get the new economy. He was a dinosaur, and the tech meteor was about to make him extinct. Buffett's response to this criticism was calm, consistent, and deeply instructive. He openly admitted that he did not understand the business models of most of these new technology companies. He couldn't confidently project their earnings and cash flows 5, 10, or 20 years into the future. He didn't know which of the hundreds of new internet companies would have a durable competitive advantage and which would be gone in a few years. Because he couldn't understand them, he wouldn't invest. It wasn't that he was saying these companies were bad investments. He was simply saying that for him, they were not knowable investments. They were outside his circle of competence. His refusal to participate was not born of stubbornness, but of intellectual honesty. He knew that the only way to have a true long-term time horizon is to have genuine conviction in the long-term prospects of the business you own, and that conviction can only come from deep understanding. Then came the crash. Starting in March of 2000, the dot-com bubble burst in spectacular fashion. The NASDAQ index lost nearly 80% of its value over the next 2 years. Hundreds of high-flying tech companies went bankrupt. Trillions of dollars of speculative wealth were wiped out. The investors who had chased the hype, investing in businesses they didn't understand, were financially annihilated. Meanwhile, Buffett's boring businesses continued to churn out profits. Berkshire Hathaway stock, which had languished, came roaring back. His decision to stay within his circle of competence had protected his shareholders' capital from a catastrophic and foreseeable bubble. This story is often told as one of avoidance, but it has a fascinating second act that truly illustrates the principle. Years later, after the dust had settled, Buffett made a massive, multi-billion-dollar investment in Apple. Why? Had he suddenly become a tech expert? No. His circle of competence had expanded. He came to understand Apple not as a technology company, but as a consumer products company with a powerful, global brand, an ecosystem that created immense customer loyalty and switching costs, and phenomenal economics. He could now see and understand Apple's moat in the same way he understood the moats of Coca-Cola or American Express. He waited until he understood the business's long-term competitive dynamics before he invested. His time horizon for Apple is not the next iPhone cycle. It's the next decade of the company's ecosystem. The circle of competence isn't a static prison. It's a boundary that you must respect. You can work to expand it over time through diligent study, but you must never, ever invest outside of it, especially when your strategy relies on holding for the long term. The psychological biases that lure investors outside their circle of competence are among the most powerful in human nature: the Dunning-Kruger effect and overconfidence bias. These two cognitive traps work together to create a dangerous illusion of knowledge. The Dunning-Kruger effect is a bias where people with low ability at a task overestimate their ability. In essence, they are too ignorant to recognize their own ignorance. In investing, this manifests as the novice investor who, after a few successful trades in a bull market, starts to believe they are a financial genius. They mistake luck for skill. They may have bought a trendy tech stock that went up, not because they understood its competitive position or valuation, but because the entire sector was in a bubble. The positive reinforcement from this lucky pick makes them feel like an expert, encouraging them to make more bets on things they don't understand. Overconfidence bias is the tendency for people to be more confident in their own abilities than is objectively reasonable. We all tend to think we are better than average drivers, have a better than average sense of humor, and are better than average investors. This bias is amplified by the sheer volume of financial information available today. It's easy to read a few articles about a company or watch a few YouTube videos and feel like you've become an expert. This creates a false sense of security and a willingness to venture into complex fields where true expertise takes years of dedicated study to develop. During the dot-com bubble, these two biases were running rampant. A whole generation of new investors, armed with online brokerage accounts, believed they had discovered a new, easier way to get rich. They saw their portfolios doubling and tripling, and attributed it to their own brilliance in picking the right new economy stocks. They were massively overconfident and suffering from a collective Dunning-Kruger effect, unable to see that their success was merely a function of being in a historic speculative mania. Warren Buffett is the walking antithesis of these biases. His famous humility and constant emphasis on what he doesn't know are the hallmarks of a true expert. A true expert is acutely aware of the limits of their own knowledge. Buffett's concept of the circle of competence is a powerful antidote to the Dunning-Kruger effect. It is a formal system for being honest with yourself about what you do and do not know. By refusing to venture outside that circle, he avoids the situations where his overconfidence could lead to a catastrophic mistake. He never lets a bull market or the pressure to keep up with a trend seduce him into a field he hasn't mastered. This intellectual honesty is not a sign of weakness. It is the ultimate sign of a disciplined professional mind. It is the psychological foundation that makes a buy-and-hold investment strategy viable. You can only hold through thick and thin if your initial purchase was based on a bedrock of real knowledge, not the shifting sands of speculative belief. To apply this principle, you need a blueprint for defining and respecting your own circle of competence. This is the Circle of Competence Audit, a self-assessment tool to ensure your investment strategy is grounded in your actual knowledge base, not your aspirations. Step 1. Map your professional and personal expertise. Take out a piece of paper and draw a large circle. Inside this circle, you will write down the industries and business types that you understand at a professional level. What industry have you worked in for the last 10 years? What are the dynamics of that business? Who are the major players? What are their competitive advantages? And what are the key drivers of profitability? Also include areas of deep, long-standing personal passion. Are you a lifelong, obsessive gamer who understands the video game industry inside and out? Are you a car enthusiast who knows the automotive supply chain backwards and forwards? Be brutally honest. This is not about what you've read a few articles about. This is about where you have a genuine, demonstrable edge in understanding. Everything else in the world of business lies outside this circle. Step 2. Create an anti-watch list. Most investors have a watch list of stocks they are interested in buying. You are going to create the opposite. This is a list of industries and companies that are explicitly forbidden to you because they fall outside your circle of competence. This might include biotechnology if you're not a scientist, complex derivatives if you're not a financial engineer, or speculative mining companies if you're not a geologist. Writing this list down is a powerful act of self-discipline. It serves as a constant reminder of where not to tread, especially when a particular sector becomes hot and fashionable. Step 3. Develop a learning curriculum. Your circle of competence is not fixed. You can and should work to expand it over your lifetime. But this expansion must be deliberate and rigorous. Choose one industry that is adjacent to your current circle or that you have a deep interest in. Create a curriculum for yourself to learn it. This means reading the top 5 books on the industry's history and dynamics. It means reading the last 5 years of annual reports for the top 3 companies in that sector. It means listening to their Investor Day presentations and earnings calls. You must commit to at least a year of deep study before you even consider making an investment in that new area. This methodical process ensures that you expand your circle with real knowledge, not superficial familiarity. Step 4. Use the Teach It to a Child test as your final gate. Before you make an investment, especially in a newly learned area, you must be able to pass the test from the business owner's checklist. Can you explain the investment thesis to a 10-year-old? This forces you to distill your knowledge to its essential core and reveals any gaps in your understanding. If your explanation is full of jargon, complexity, and hand-waving, you don't truly understand it yet. Go back to your curriculum. The Circle of Competence audit is a career-long project. It replaces the haphazard, trend-chasing approach of most investors with a disciplined, knowledge-based framework. It ensures that your long-term time horizon is built not on blind faith, but on the unshakable conviction that comes from truly understanding what you own. The antithesis of this disciplined approach is the, quote, jack of all trades, master of none investor. This is the individual who believes they can be an expert in everything. They chase trends and headlines, jumping from one hot sector to the next, armed with only a superficial level of knowledge. Their portfolio is a chaotic reflection of the last 6 months of financial news. 1 month, they are an expert on cannabis stocks because they read an article about legalization. The next, they are a deep tech investor because they saw a segment on television about artificial intelligence. Then, they become a commodities trader, buying silver because they heard a podcast about inflation. For this type of investor, the idea of a circle of competence is limiting and boring. They crave action and the excitement of being involved in the story of the day. They suffer from a terminal case of FOMO, fear of missing out. They see a stock like Tesla or Nvidia soaring and feel an irresistible urge to get in on the action, even if they have no deep understanding of electric vehicle battery technology or the competitive landscape of semiconductor design. Their research is often a quick confirmation bias loop. They decide they want to buy a stock, and then they search for articles and social media posts that confirm their pre-existing desire. They are not engaged in a sober assessment of a business's long-term prospects. They are seeking justification for a gamble. The inevitable outcome of this approach is disastrous. Because their knowledge is shallow, they have no real conviction. When one of their high-flying stocks inevitably hits a patch of turbulence, a bad quarterly report, a new competitor, a negative regulatory ruling, they have no intellectual foundation to fall back on. They cannot distinguish between a temporary setback and a fundamental impairment of the business. Their only guide is the stock price. So when the price falls, they panic and sell. They are the quintessential weak hands shaken out at the first sign of trouble. They will often tell themselves a story to justify their loss. The stock was manipulated, or the CEO lied. They will rarely admit the simple truth. They invested in a business they did not understand and were therefore psychologically incapable of holding it for the long term. This path is a surefire way to underperform the market. It combines the worst of all worlds, the risk of concentrated, speculative bets without the conviction that comes from deep knowledge. It is a frantic and ultimately fruitless endeavor, a perfect illustration of the costly consequences of ignoring one of the most fundamental rules of successful long-term investing. The direct financial connection of staying within your circle of competence is the dramatic difference between investment returns and speculative returns. It's the difference between the high probability of a satisfactory outcome and the low probability of an extraordinary one, coupled with a high probability of a terrible one. Let's quantify the impact on a portfolio. A circle of competence portfolio would be concentrated in, say, 10 to 15 businesses that the investor knows intimately. Because of this deep knowledge, the investor is likely to have a much better than average ability to assess the long-term prospects of these specific companies. This doesn't mean they will all be winners, but their hit rate of picking successful long-term compounders should be significantly higher than average. Let's say they can achieve an average annual return of 12 to 15%, outperforming the market average of 10%. Over 30 years, the difference is astronomical. A $100,000 investment at 10% grows to $1.74 million. At 13%, it grows to $3.91 million. That 3% edge, derived from superior knowledge, is worth over $2 million. Now consider the master of none portfolio. This investor might have dozens of positions in hot sectors they don't understand. Their portfolio is a grab bag of story stocks. While they might get lucky with one or two, many of these speculative companies will flame out and go to zero. The big winners they do find, they are likely to sell far too early, as we've discussed. The net result is a portfolio whose returns are likely to be eroded by these complete losses and by the constant churn. It is highly probable that their long-term return will be significantly less than the market average, perhaps in the range of 5 to 7%. At 7%, our $100,000 investment grows to only $760,000 over 30 years. The financial cost of venturing outside one's circle of competence is, in this example, over $3 million. We can see this effect directly in Berkshire Hathaway's financial statements. A significant portion of Berkshire's long-term outperformance has come from massive, concentrated bets in just a few industries that Buffett understands deeply: insurance, banking, and consumer staples. His discipline in avoiding areas he doesn't understand, like in the dot-com bubble, has prevented the catastrophic losses that wipe out most investors. Preventing large losses is the unspoken secret to great long-term returns. If you lose 50% of your capital, you need a 100% gain just to get back to even. By staying within his circle, Buffett avoids the big mistakes. This loss avoidance is a massive, quantifiable contributor to his long-term record. The final financial connection is this: your circle of competence is your personal competitive advantage in the market. It is the one area where you can, with diligent work, know more than the average Wall Street analyst. By exploiting this edge and having the discipline to ignore everything else, you are tilting the odds of long-term success dramatically in your favor. It is the ultimate fusion of a long-term time horizon and intellectual honesty, a combination that is the bedrock of any intelligent investment strategy. You have just spent this time re-engineering the very clock inside your mind. You have acquired a powerful mental tool, the ability to see the world of business and investing not through the myopic, distorting lens of the next 90 days, but with the calm, clear perspective of the next 10 years. You now understand that the market's volatility is not a risk to be feared, but a resource to be exploited. You've learned that the true engine of wealth is not frantic activity, but the patient, uninterrupted work of the compounding engine. You now possess the mindset of a business owner, not a ticker-tape renter. You have a blueprint to be greedy when others are fearful, and a framework for acting only where you have a decisive intellectual edge. This is the foundational operating system of the world's greatest investor, and it is now yours. But this profound shift in time horizon, as powerful as it is only the first piece of a much larger, interconnected mental arsenal. It is one critical node in a network of models that work together to produce consistently rational, wealth-creating decisions. Having this long-term perspective is like building a powerful, world-class engine. But an engine, no matter how powerful, is useless without a chassis, a steering wheel, and a map to tell you where to go. You have the ga, when, the ga, how long. But what about the vefa? What? What about the ara, how much? The video that is now on your screen is the next piece of that map. It is the link that connects the powerful engine of long-term thinking you've just built to the road of practical application. It bridges the philosophy of time with the mechanics of value. It is the next essential model in the network, the technique that allows you to look at any business and, in a world of chaotic noise, determine its one true quiet signal, its intrinsic value. Many will stop here, content with the powerful idea they've just learned. But the journey of the intelligent investor is a continuous ascent, a process of layering one mental model upon the next until a complete latticework of wisdom is built. The choice is yours. You can be the person who just has a powerful engine sitting in their garage, or you can be the person who builds the entire machine and drives it toward true and lasting financial freedom. If you are ready to continue that ascent, to install the next piece of the mental machinery, then your path is clear. Complete your arsenal. Click and continue the journey.